So the survey says, hold your nerve, go for growth, don't panic. Are you in the don't panic and stoic seat? Good morning.
A very good morning to you, Manus. So we're still risk on. We're holding our nerves here, and we maintain that clients remain risk on during this time as well. However, our preferred sectors within the U.S. equity space include names like energy and financials, industrials, and not particularly technology, where we remain neutral on.
And in terms of the great debate, we saw some wobbles in the tech space last week, as I said, moves of plus or minus 1% in 8 out of the past 10 sessions. How do you look at technology at the moment? This rotation from growth to value, one needs to be quite discerning, I get the sense at this stage, rather than just going all out of growth and all into value.
So we've been sharing this with clients for quite a while now. Our preference to go into rotate out of growth and momentum names into cyclicals and value-oriented sectors. We've been saying that for quite a while, and we've seen clients act upon it as the tech sector was very overheated last year. And quite candidly, they've really had a decade of stellar returns. And in terms of fundamentals, while they still look solid, the valuations do look very steep for a lot of the tech names, despite the sell-off. And in general, the market overall looks pretty overvalued at this time. But given the fiscal and monetary policies and the accommodative Fed, we see more upside in the U.S. names going forward.
Okay, and I think everybody's working off the assumption that easy terms, financial conditions remains absolutely unabated from the Fed for now. Ali, Kit Duke's, the language that he used in regards to the bond market was that we're trying to find a new equilibrium, but there won't be any peace until we get 2%. The two things make eminently good sense to me. Do you get the sense that we are seeking a new equilibrium, and does that mean testing 2% before we're sated?
Absolutely, Manus. You're spot on. So we are moving to that new equilibrium, so to say, and what was unimaginable at the end of December when the 10-year is trading below 1%, around the 0.94% mark, when we're talking about 1.64% now as of Friday. And what seemed a couple of weeks ago as just touching 1.6 and coming back down and stepping around the 1.5% level proved that wrong on Friday when it popped up over 1.64% again. So I do agree that there's a new equilibrium that we're heading to. And to position ourselves for the new equilibrium, earlier on we'd gone underweight on the developed world investment-grade bonds, and now we've gone underweight on emerging market investment-grade bonds as well, because they tend to be higher duration, and we do expect the further steepening of the yield curve.
Do you think that that's an early move, or are you seeing signs that other people are beginning to prepare? I was looking at the primary dealer position on the developed market, on the Treasury side. They've reduced their holdings of Treasuries to the lowest since 2018. So where are we in the cycle of that repositioning you've just outlined?
I think we're right in the smack in the middle of it, because if you just also look at the fund flows, you'll notice that we're now seeing a huge, drawdown on bond funds, whether it be investment grade, developed world, or emerging markets. So I think the market's beginning to realize this. The investors are beginning to get a feel of this. And there's a lot of, we know in this region, and we see recent banks come out and issue perpetuals, and a lot of investment grade entities in the Middle East, for example, issued 30 and 50-year bonds, which was not very common a long time ago. So with such high duration, I think markets finally coming to grasp with the fact that maybe we need to be in other sectors of fixed income and not investment grade particularly.
And where else would you want to be apart from that, apart from that exposure?
Well, that just leaves us with our good old favorite, the tried and tested horse. I think that's worked out very well for us. the emerging market high yield space, where we still see value. I mean, it looks more attractive in a valuations perspective vis-a-vis emerging market investment grade. It also looks exciting from a durations perspective. And within emerging market high yield, Asia has some of the lowest duration when you look at it from a geographical basis, as opposed to Latin America, which has one of the highest Latin American bonds, corporate bonds have the highest duration. So within Asia and within emerging market high yield, where we remain bullish.
So there seems to be growing doubt that we're running out of steam on the oil rally at $70. Is it becoming a little bit overblown and overdone for you, Ali?
So, I mean, we're still bullish on oil. We see it hitting the 72 levels for Brent in 12 months' time. I think it will self-limit itself at one point, and that point is so far away from that point. In the mean term, we've got excellent discipline from OPEC+, both in terms of, the supply cuts and just maintaining a one-off cut from Saudi. We also see sturdier global oil demand. We also feel that the recent events in Texas will, affect Texas output. So a lot of reasons to continue supporting it. When I say it will, it be self-limiting, because I feel at a certain point they'll have to increase production again. At a certain point, shale will come back in. And then, of course, there's always this black horse and outlier in Iran coming back to the oil market. So while I do agree that most of it, the rally is done, but I see still some legs to go.
I'm just looking at gold. Look, there was a lot of, I would say, discombobulation last week. Yields spiked. The dollar was unsure, came back, a drawdown of about 0.25%. But I look at what happened in the gold market. We put it in the GTV library. This is specs cutting their bullish positions on the bullion for the 6th straight week. That's the longest slump since 2017. My difficulty with this is that if we are in a new inflation regime where yields will trade up to 2%, is gold losing its luster as a hedge? I look at Bitcoin at $61,000 this morning, and this gold repositioning. Can you make sense of this scaling back in the specs for me?
Absolutely, Manus. I think you nailed it on the head. Prior to this, there really was no digital alternative to gold per se. We've had to, eat the humble pie with our forecasts for gold, which were, pretty extravagant until we had to recently cut them now to $1,900 an ounce and $1,850 an ounce for the 12-month forecast. And it's just because the crypto is offering, while we still consider it a speculative trade, but the sheer size of the inflows that have come into Bitcoin has really taken the gloss off investor demand for gold. Despite rising rates being higher, we just think it's also going to be a negative, weaker USD, which is going to help gold prices still regain some. But we also think it's going to be just a limited upside potential from here onwards, despite, of course, economic recovery in China and India, increasing demand for the good old jewelry. But it just feels like, we prefer silver between the two.
Okay, now tomorrow we're going to get a little bit more data on the Chinese side, aren't we? So we're going to see what progress we can make towards the 6% floor, ambitious hopes of 8% in terms of growth. We're going to get retail sales, industrial production, and fixed asset investment. Tomorrow's incredibly important. What's going to be important in China for you? What's going to change the narrative to take more exposure to China? Because we've seen the national team at play in the past 10 days.
Absolutely, and China's been very tricky in terms of market performance over the last couple of weeks, so there's no shying away from that. Well, we already have quite a significant adequate exposure in China, first through our overweight position in Chinese equities, one of our favorite equity plays within AGX Japan, and then, of course, our bullish position on emerging market high yield debt, where we like the Chinese property sector is one of the places that we quite like. Like you said, a lot of exciting data coming up out of China next week that we'll be keeping a close eye on. However, we think that the economic recovery will remain supportive, and both monetary and fiscal policies out of China will be supportive for risk assets in China going forward.